Today's guest is a RealWealth member and an IT professional who shifted his investment strategy from traditional financial advisor advice to real estate. We'll hear about how he built a portfolio across Memphis, Kansas City, and Florida. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
Our guest today, Tim, used his tech background to optimize his investments and scale efficiently. After years of managing rentals, he shifted into syndications and appreciation-focused assets, rebalancing his portfolio with the help of a mentor and acquiring 11 properties in just 18 months. In this episode, Tim shares how he went from cautious observer to a confident investor and how he's designed a lifestyle centered on flexibility, freedom, and long-term growth. Well, Tim, welcome to the RealWealth Show.
Hi, thanks for having me.
Let's go back to the beginning. I always like to start there. What got you interested in real estate and what got you started?
Yeah, so out of school, I read the Rich Dad Poor Dad book. My cousin read that too, and he just jumped in with both feet, started buying a bunch of real estate, and I wasn't really ready to do that. I was really more in that millionaire next door type of camp where like just earn more than you spend, invest, and then focus on family and career.
That's so funny. That was a big book for Rich and me too. It's a great book, but yeah, it's a slow way to build wealth for sure.
For sure, and over time, I had looked at how 401ks actually worked, understood what, and we would max out, our IRAs and 401ks. And once I figured out how expense ratios worked and how financial advisors are paid and what's going on with these funds, and then it started getting a little bit skeptical about like what's actually happening here. And so then the 2008 crash happened, and everybody saw a dramatic decrease in their savings. And so I started really getting curious about like what do I do to protect my own financial future, because this is too risky for something like this to happen, and then for me to not really have any control over that. And so talking with my cousin, he sort of gave me a challenge about, well, I spent all this time learning about technology and learning new languages, platforms, and tools. He's like, well, if you're so smart, how come you're not rich, right? And why don't you apply that to learning about real estate and your financial future? And so I sort of thought about that. Yeah, for sure. And, and I worked with data analytics, and, these were skills I was already good at. And so if I were to take some time and apply that to learning about real estate investing and understanding my financial education, I thought that would be worthwhile doing early in my career instead of, only focusing on career goals. So I decided to take a year of my commute time and my learning time and read books about real estate. And that's how I found Real Wealth Network. I really appreciate having that as part of my journey and attending webinars. And I really like your focus on real estate investor education. And I love how you brag about when you have your network ask experts, and they're a very well-informed group. And so I think I definitely see the importance of financial education and understanding how these asset classes work in order to secure financial freedom.
Oh my gosh, I just love everything that you just said. That is so true. There's so many brilliant people out there that just haven't taken the time to use their brilliance to understand how to truly build wealth. And, we spend all our time, so much of our time, learning to get a career, getting a career, but then having no idea what to do with the money once you get it, or how to make it grow so that you don't have to work forever. So good on you for using your car as another college degree. I think that's what you said. You listened while you're driving. Is that right?
Yeah. So again, having a commute where podcasts were definitely something I would listen to, a lot of tech podcasts, but I started listening to Keith Weinhold, Get Rich Education, and Real Wealth Show, of course, and bigger podcasts as well. And those started down a path of then I started getting curious about what other questions to ask. how would you get started? What are the risks? I think when you talk to somebody who's not in real estate investing, they see it as super risky and they just avoid it. But you can combat that risk by having education and understanding that asset class, understanding a market, and then figuring out like what's the right price point. And so once I realized too, I could analyze deals with no intention of purchasing, but I could just use that to improve
Yes.
my skill set and get to a
Yes.
spot of um, knowing what kind of spreadsheets I would want to build in order to figure out, could I make this deal work? And if I did, what kind of capital would I need? What kind of loan terms would I want? And how would I build out a team for support with property management? What are the insurance costs? And if you're a homeowner, like it all works a little bit different than if you're purchasing a property for a real estate investment.
Oh, this is so good. Going through the motions, going through the steps of what is it going to take is so powerful because people do think, well, I better not start looking at properties until I'm ready, until I have my financing in place. And sure, you should have your financing in place, but still, just because you've done the legwork doesn't mean you're committed to the deal.
Right.
As a parent, I did this with my youngest daughter who, said, she's ready to acquire real estate. And I said, great, just start to send me some deals. Start to send me some deals. I'll see if I want to be an investor in one of your deals. That will have her go through the process. I've yet to receive one. So this is advice to parents. Never say no. Just give a job that they have to do to come back and negotiate further. But yeah, just going through the footwork and the process is so important. So again, great information that we're sharing. Appreciate
Yeah,
it.
and I think I kind of also fell into that trap of, well, I have to pay off my own house before I buy a house for an investment,
Yeah.
right? And there's no rules on that. You don't have to do that. You can have your own home, and you can actually tap that equity and reinvest that into other assets for investment. And so this is where, like, kind of in our personal life at that time, my wife is a farm girl. She's got hobbies that take a lot of space with fruit trees and chickens and a garden. And in town, like, we just decided that our family, we would prefer to live outside of town and have an acreage. And so when we moved, we remodeled our home, and then I had this choice to make where I could pay off our house and be debt free, like, and this was like the Dave Ramsey mindset, and just have no debt, right? And or I could cash out, refinance our acreage, and use that as seed money for getting started with real estate investing. And so this is like right after I purchased my first investment property, and at some point where I think it was one of Keith Weinhold's podcasts, he kind of almost broke character a bit and said, knowledge is great, but unless you do something with it, it's not going to help, right? So fortune favors the bold. And if you can just take action, you are going to make mistakes, but you can learn from those mistakes, and there's options, you have ways to recover. And so that's where, after I had my first deal under my belt, then I could see how these processes, these systems, and have my property management in place. And at that point, it wasn't so scary anymore. And I was sort of like in my mind thinking, oh, I'll have to like learn more and do another year before I can invest in my next property. And like, the next deal is just a copy and paste. I don't have to wait, right? All I need is capital to do that with. So this is where,
Yeah.
when we refinanced our house, and this was when rates were below 3%. So I was able to take, on the one hand, there was this Dave Ramsey mindset of like live debt free, and there's the other hand of like Robert Kiyosaki, which is to buy assets and avoid doodads and buy things that grow wealth. And so we extracted about $250,000, and I invested that in 8 more properties over the next 2 years.
Wow. That's amazing. So I do want to address this because it's a scary thought for people to leverage their primary residence.
Mm-hmm.
And I look at it like leverage is leverage, right? If you take out debt, you got to pay it back, regardless of what it's tied to. So I mean, unless you're getting a non-recourse loan, but most people aren't in the beginning. So why not, if you're going to borrow money to acquire assets, to have someone else pay them off for you and do the whole real estate plan, why not get the cheapest money possible, which is borrowing from your primary residence? Banks are most comfortable with that and they make the money the cheapest. So why wouldn't you do that? As long as you are investing it with there's no certainty, but in the most quality assets that you could get. Obviously, you don't want to leverage your home and then go invest it in crypto or something volatile and lose all your money, but when you've got a solid plan, like you said, copy and paste, this works, I'm going to do it again and again, borrow the cheapest money. So I'm that's one thing that I really just really feel strongly about. And you've got to be able to make your payments, right? You've got to have plenty of reserves set aside in case there's a rainy day. Yeah, that's the key.
Yeah, so I think one way to think about like combating risk is there's other mechanisms at play where if you can't sleep at night because you're afraid of not being able to make payments, you probably don't have enough reserves. And so
Yes.
making sure that you have enough reserves for your what you're comfortable with, whether it's 6 months or a year. Of if all properties are vacant, like what's your time frame? How long can that last, right? If both you and your spouse lose your jobs and all properties are vacant, like what is your burn rate? And so again, those are I think unlikely scenarios, but you can at least do the math to figure out what is your risk tolerance and what level are you comfortable with.
Yeah. Okay, so where did you end up buying 9 properties?
Yeah, so initially with my spreadsheets, I was focused on cash flow. And so Memphis was a really good market for finding properties where um, you could buy a property that would cash flow with 20-25% down. Now, where I live, I was kind of in that mistake early on of I wouldn't want to buy a property that I wouldn't live in myself, and then
Uh-huh.
you just can't find a property where you can make the numbers work. And so this concept of buying a property that you've never set foot in before, that sounds crazy to a lot of people. But if you can make the numbers work, and then you have property management, and they can help you find a qualified tenant, um, there's no reason that can't work. And so the three markets that I started in were um, Memphis, Kansas City, and Deltona. And so most of those were, let's see, the Kansas City and Deltona were both RealWealth Network recommended connections. And then the one in Memphis, I think I got from my cousin because he already had properties in that market. In fact, I bought one of the properties from him. So
Amazing. So what have you learned since then?
yeah, so after having 9 properties with 3 different property management companies, about 4 different insurance companies, and 8 different banks, it was it was really difficult to manage just all of the things that would come up and surface, whether it was a maintenance request, a problem with late payments, repairs, and these older properties that needed a lot of attention really kind of got me down, and I felt like I had bitten off more than I could chew. And so while I could see the cash flow on paper, oftentimes there would be a setback with one property, whether it was a plumbing repair or a furnace or a foundation problem or flooding or trees or like you name it, I've seen it. And so these are the things that, I don't know, make you a seasoned investor. And, when I was talking with my cousin and kind of complaining about all of the maintenance items, he asked me to like think about, okay, so over your whole portfolio, are you cash flow positive? And I had to go back and catch up on my spreadsheets and check. I'm like, yeah, over the whole time, over my whole portfolio, I'm still cash flow positive, but it would be a whole lot more profitable if I didn't have all these maintenance problems. It's like, okay, well, your success has paid for your mistakes, and you got a free education, so now you know how this works. And so that radical optimism was, I think, hard to face, but I could see his point, and I could see that okay, now that I've learned these things, I can maybe avoid some of these mistakes going forward, and I can change my approach and fine tune things so that I'm not just constantly like using my time and pouring more money into these properties with repair items.
Yeah. So, looking back, what would you do differently, or what do you do differently today versus when you started and you got that free education?
Right. So what I realized was that these were linear markets, and there was a event that RealWealth hosted where with one of your partners, where there was a mastermind event, and so I was looking for, oh, I'd love to go talk with an expert, find a mentor, and figure out what can I do to optimize my current portfolio. No intentions of moving, selling, maybe not even really looking to purchase any more properties. But at that point, I'd kind of shifted into syndication deals because they were just they took less of my time, and I knew I could still put new money to work without having to have um, have more interruptions or cognitive load from my personal life. So with this mastermind event, um, even just like filling out the intake forms to see how much capital I had tied up and what it was producing from a cash flow standpoint, it was kind of eye opening because I could see that there was a lot of appreciation in that 2022 20 time frame, and there wasn't much I could do to redeploy or use that capital without selling it. And I knew that 1031
Hmm.
exchanges were a thing. Wasn't really sure how they worked or how to do that or what the rules were. I just knew it was complicated. And so once I found out about what was possible and realized that most of the wealth that I had was not cash flow; it was all appreciation. At that point, I
100%.
realized that my strategy had to change in order to leverage that more efficiently. And so, working with a mentor, I realized I was in the wrong markets. And so, I had capital built up. I guess I call myself the lucky to just be in the right position when we had a bunch of accidental appreciation due to inflation and other factors. Housing shortage, for example, too. And so once I was able to see a way forward and to reinvest the capital that I had accumulated into new markets to basically repeat that appreciation growth again, that's kind of where once I had a strategy in place, I followed a process in order to sell 9 properties, purchase 11 properties into a growth market instead of linear markets. And that was a lot of work, but I closed on 20 properties in 18 months.
Oh
And
my goodness.
yeah,
Wow. That is a lot of work.
yeah.
How many loans? 20 loans?
Um, no, so 9 sales and 11 purchases. But
Okay.
still,
Okay.
like stacking and doing like rolling 1031 exchanges. Here's something I didn't know about 1031 exchanges: is you can merge and split the money from a 1031 exchange. But then there's
Hmm.
specific time frames. There's that 45-day time frame and the 6-month time frame. And so having to have everything line up perfectly so that you can have a sale happen and then you can redeploy the the proceeds into the new property. That was challenging, but I have a lot of spreadsheets where I was able to make that happen.
Wow. Yeah, these are such big lessons. I also was a fan of Robert Kiyosaki, still am. I had him on the show, on the Real Wealth show back in 2005, and he was really the one who encouraged me to begin investing out of state, specifically in Texas. That's how Real Wealth was formed, was from, the thinking of Robert Kiyosaki to get to sell all the high price properties in Florida, California, Nevada, and Arizona at the peak of the market in 2005 and redeploy that in Texas, which was poised to boom, hadn't yet, but had the strongest job growth, population growth in the country with that, with also the lowest home prices. So, with that many people moving there, eventually eventually the housing would get bought up and new housing would be needed and prices tend to go up. So I followed him and the cash flow model. It worked in Texas because of the growth. But then I did the same thing, went to the Midwest and bought high cash flow properties, but not with the same dynamics. So the teachings of Kiyosaki were get out of the high priced bubble markets, get into cash flow markets. But the caveat there was cash flow markets with population growth and job growth. That's the combination. And that would totally work. Like I said, in Texas, didn't work in areas where they were actually, there's parts of Ohio where there's population losses and job losses. And it's going to be really hard to find appreciation in those areas. So the cash flow may look good, but I'll tell you what, one repair can wipe out cash flow for a year, in some cases 5 years,
Right.
hard to build wealth that way.
That was just, I think, my experience too, is making sure that like cash flow is just there to buy you time. Cash flow is not something you're going to tap into and like live off of, at least not when you're in growth mode. And so recognizing that cash flow is just there to build a buffer for when something happens. And if you have extra cash flow that you can then reinvest, then great, it's bonus, right? But looking at cash flow as just a way to let that investment ride while you're
Pay for itself.
yeah, pay for itself, exactly.
Yeah, no, this is such important information that if you really want cash flow, if you're seeking cash flow, you've got to look at it like you'd need $1 million equity, $1 million either put into the property or that you've earned over time to earn about $60,000 a year if you're getting about a 6% return after all expenses. So unless you have $1 million or two or three or four or five to invest in cash flowing real estate to get that kind of return, you're not cash flowing. You're not cash flowing if you're putting 20% down on a $200,000 property, right? You're breaking even. And it's just so important for people to understand this. You have to have money to really genuinely cash flow to a point where you can replace your income. So how do you get to the point where you have money? And that would be acquiring assets that grow over time while you sleep, while you're doing other things, while you're getting your cash flow from your job, but you're also buying these assets that are growing you wealth over time. Then you got your $1 million equity or 2 million or 3 million or whatever. Then you go into cash flow. That's my big lesson too.
Yeah. And so like in your book, Scaling Smart, you really, again, talk about how do you take that systematic approach in order to grow wealth. And so like from an IT a technology standpoint, if we want to optimize something or have it scale, like you would do things in parallel. So I have a lot of friends where, they bought homes, for 200, 250, and then they're so happy that their home is appreciated to 300 or 400. And so like, why not do that times 10, right? If you have properties across the board and you can spread out your wealth, your capital into many different properties, then they're all appreciating in parallel. You also have like automatic diversification built in because it's not like you're diversified in just real estate. Each different property is essentially its own diversification. And then you diversify with each market too. And so I really see like even in the last 2 months when we've seen a lot of volatility in the stock market, I guess I'm just glad that I have diversification with real estate because it just moves much slower and it's a lot more stable over time. And so it's easier to weather the storm when there's a lot of volatility in the market.
Oh my goodness, isn't that the truth? I sit here and watch all my friends and people who are more invested or completely only invested in the stock market and what a volatile year it's been. And I look at our portfolio, which, I'll admit is far too invested in real estate. And we haven't felt a thing. And if anything, it's been positive because fewer people can actually afford to buy a home. They are forced to rent. This is the exact same thing that happened during the great housing crisis of 2008 when the whole housing, the whole worldwide economy had fallen apart. The stock market had crashed. People were losing their homes everywhere. But our members at Real Wealth did not feel the pain. Because not all of it, some did, I'm sure, because, if they invested too heavily in California and areas that we didn't recommend. But otherwise, if you were just kind of a landlord with already having your properties during that time and you got into good loans that weren't adjusting, or, that if you got into fixed rate, you actually saw your rents go up. You actually had increases in your income over that time when the massive recession was happening. So it is a solid investment if you do it right. Now, if you're going to get into an adjustable rate, like we see in multifamily, and in 2022, the rates go from 2% to 6 or 7 or 8. Well, sure, that's going to hurt your project, your property, but that's mostly commercial real estate today. It was residential real estate in the early 2000s. Today, it's commercial real estate that's been on those adjustables. But most people who have 1 to 4 unit properties, like most of us at Real Wealth, you're on fixed rate. So, you're not feeling a lot of pain right now, right? As long as your tenants are paying your rent.
So most of my new properties are 7-1 ARMs, and that is because this is actually one of those moments where I struggled because I was giving up these 4.5% rates in these other markets, and then going into these loans that were 7.5, 7-year fixed rates or 7-year adjustable, and realizing I felt like I was losing something because of giving up those great loans. On the other hand, instead of looking back, and this is where mentorship helped me kind of break through this, instead of looking back to what I should have done or what I could have done, like looking forward to see like what would happen, or what would I wish I had done 5 years from now. And so the only thing I can change is what's happening now. And the other, I think, mantra is like date the rate and marry the house, right? Which that's where like you can get the purchase price now, but if we have a more of a housing shortage, or if rates do come down, then what's going to happen to home prices? They're just going to bounce up. Flash forward, this insight where because rates were 7.5, builders couldn't really get buyers, and so there was a ton of incentives, and so there was a lot of equity capture that happened, where I was getting homes like brand new construction 15, 25 less than the appraised value because rates were high and there was a lot of people waiting on the sidelines for rates to come down in order to purchase something. So by taking advantage of that market condition and purchasing new construction homes and making them into rentals with 1031 exchanges, and then the rates aren't great, but if rates, they still are cash flow positive. And so I don't need to cash flow. I don't need to maximize my cash flow. I just need enough cash flow in order to make the acquisition happen and buy the deal. And so that's also where maybe 20% won't cut it anymore. So you'd have to do 25 or 30% in order to make it cash flow. Now, if I have a chance to refinance, then I can also get some of that equity back out and redeploy that into a new property. And that's another mechanism to do that without any tax consequences. So there's a lot of options. And in the meantime, I can just wait and see what the market does. And then I'll be able to run it through my spreadsheets and calculate like when should I actually refinance, or would I sell it before a refinance even came up?
Yeah, you just have to constantly be looking at what's the opportunity that's being presented, and what has been presented over the last couple of years is kind of a deal on new homes. And as a landlord investing out of state, who wouldn't want a brand new house versus an older one that's breaking down all the time? How about a bunch of brand new ones that you can get at a discount, and you can have the builder buy your rate down for you so that it does cash flow? That's been the opportunity. That's what we've been focused on at Real Wealth. In growth markets, that opportunity is still there. So I couldn't agree more. I mean, Rich and I started investing in brand new homes, and people would kind of laugh at us like, "Oh, that's not really investing. You're just buying you're not going and fixing it and doing the work of an investor. It's like, yeah, exactly. I'm buying it new at a discount in a growth area at a fixed rate. And this is for a long-term investment. So I want it to be in great condition. I want it to be new. I'm going to hold it for 20 years. It's going to be 20 years old at some point. So good for
Yeah.
you. And you're young enough that a new house makes sense. You could probably get a hold of it a long time.
Yeah, there's some other benefits to doing that too. So for the first year, you have a builder warranty, and so a lot of things that would
Yes.
break that would come up are automatically resolved by the builder. Another benefit to new construction is that the taxes are usually assessed at land only for that first year, because the property taxes aren't assessed until a year later, and so you have a whole year of extra cash flow. So in my spreadsheets, I'm usually pretty conservative with that, and I just automatically put it in, like, what's it going to cash flow when the taxes actually kick into full valuation. And so I have a lot of ways that I choose to reduce risk by making sure that I can make the numbers work.
Love it. And then where did you buy these new properties?
Yeah, so these properties are in Texas.
Texas. Yeah. Great market. You just can't go wrong there. Oh, Tim, well, I could just talk to you forever, but we are out of time. So any last tips for our audience today?
Yeah, so I would say, number one, do your own math. Like, make sure, don't look at a pro forma and say that that's going to be good. Like, you make your own spreadsheets, make sure you understand what's happening, ask questions, and it's going to make you a better informed investor. And it's going to help you make sure that you are taking responsibility for your own decisions. And then start small, but like, get started. Don't delay or drag your feet, because if you're thinking about buying your first property and you haven't done it yet, like, figuring out that first one is the hardest part, and then you can see and understand how things work, and you'll ask better questions going forward. And then for me, mentorship was a key part of my strategy. And I think in the last 2 years, when I've been part of a mentorship program, I've learned more than I have in the last 10 years of just figuring stuff out on my own. And so even like being an avid learner, trying to read books and listen to podcasts, until you actually have experience, like, it's hard to internalize like what some of these things mean, and how do you make yourself a better investor. But it is a knowledge base and a skill set that you can get better at. And so if you're open to learning and spending time doing that, there's a lot of opportunity to take control of your own financial future.
Love it. All right, Tim. Well, thank you so much for joining me here on the Real Wealth Show. And I hope to see you at one of our live events soon.
Thanks, Kathy.
And thank you for joining me here on the Real Wealth Show. If you would like a mentor, you can go to realwealth.com/1500. That's our website where you can download a free PDF on the top 5 cities to invest in. And while you're there, you can also join Real Wealth and get access to one of our investment counselors who can help you on your real estate journey. I'm Kathy Fettke. Thanks so much for joining me here on the Real Wealth Show. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.